So continuing to the next example, we have King Solomon's Mine, and basically this is page 282, and we have Kingsley Solomon's considering a proposal to open a new gold mine, estimating will cost 500 million to develop. Production is 1 million ounces a year. Total production is going to be 1 million ounces. Current gold price is 1,500, and production cost per ounce is 11.50 per ounce. So with this, all this is the example is giving us essentially a distinction between two NPV calculation. The first, and I think it's a good distinction just to simply see the nuanced way of calculating NPV in different situations. So as you see here, the first one is we're just assuming the gold price is forecasted to rise at 5%. So our NPV is basically looking at our production per unit here. This is everything per unit produced in a way. So we're multiplying the spread times 0.1 and each year's spread, and we're dividing by the discount with the proper exponent to discount, and we're getting negative 35 million. So it looks like, hey, we shouldn't be doing gold prices rising 5% with our cost per unit and the investment and everything added up, negative 35 million. Don't do the gold mine. And then on a second look, basically we can see that actually we don't need to value gold in the future, as gold is a commodity, it doesn't pay dividends. So actually the 1,500 is the discounted value of the expected future gold price, which makes sense. It's like gold is not going to be paying any income or dividends, it has no earnings, there's nothing to discount. All the current fair value is the expected discounted value of future values. So if you want to look more regards that, it's in footnote 6 on page 283. Investing in an ounce of gold is like investing in a stock that pays no dividends. The investor's return comes entirely as capital gains. So this is something that's true. So just a nuanced valuation regarding commodity, which can be sometimes, a little tricky. We can see here that now minus 500 plus 1,500 minus the sum from 1 to 10 of just the discounted costs of each year per unit times the number of units produced, now giving us 293 million, which is a positive. And now the gold mine does seem like a good idea. So this is another example to walk through just to get an understanding. It's not always clear cut completely with NPV, but very good to go back and triple check. Do projects have positive NPVs? Now, rents equals profits that more than cover the cost of capital. In other words, we're talking about rents, which is basically the profits more than the cost of capital. So NPV is basically the present value of these economic rents. And rents only come when you have a better product, lower cost, or some other competitive advantage over the market. And the ideas we're talking about is that if that is going to look attractive to competitors, because it's kind of like easy money, if say it's kind of like easy money, so to speak, then more and more people come in and things happen. I mean, think kind of like real estate back in 2004, where prices were rising rapidly. Look what happened. I mean, it's not the greatest example, but how many players got involved? And I mean, the moment the word easy money comes into play, it becomes attractive to other players. They come in, they set up shop. It may take a couple of years for whatever they're doing to take effect. But what's interesting in our projections is that we are trying to estimate these projections and figure out the price adjustment in the years after the new player comes into play to see what's going on. And this is what the Polyzone production NPV is all about. If you look on page 286, 287, we're talking about essentially, hey, a U.S. company shipping a chemical out to Europe, stable price, stable NPV. Initially, the NPV looks like at 63 million, on this notion that they're producing this chemical, and the spread per pound that they're selling is 1.2 initially. They're getting a nice revenue of 96 million essentially a year. In years 3 to 10 is when they're able to basically ship all these units out. Initially, they're just investing for the first 3 years. And the whole idea here is they're saying, hey, we're shipping this thing out to Europe. What about the European competitors? What happens if they become somebody that can compete and somebody that can lower the price? Because, of course, they don't have the transportation cost. So what they do next is they look at what would be, for a European company with transportation cost zero, how would they be able to do that? At what price would they be able to get a zero NPV? And it turns out that that's 0.95. At 0.95, you see there is a revenue of 76. Then they have their production cost, and other costs. So basically, at NPV, at that rate, the NPV is zero. So that's where the price will gravitate over the years. So the idea is that if that's where things were, like let's say they're able to hold the price for the first couple of years, but then after year 4, the European competitors are starting to catch up. They're building their plant. Their plant is starting to come online, which makes a lot of sense in year 5 to 10. That's what the price will be. And with that kind of spread with revenue of 76, cost of 30, the 8 becomes a big deal. And with this kind of NPV, we're looking at a negative 9.8 NPV, and we have a negative profitability. So in this situation, we're able to notice and save this $100 million investment. That's basically what it is, preventing the $100 million mistake by forecasting and essentially seeing what would be a zero NPV scenario should a European company get involved. And with these kind of spreads, why not? Because it's potentially easy money for them since they have no transport costs.